has definitely come off from the day's highs. So the Nifty is now up just about 50 odd points. It was up in excess of 100 points at one point in time. What's dragging the market? In the broader markets, actually, Marico is the one that's taking it on the chin this morning, down 5% after reporting a gross margin contraction compared to what they saw last quarter. Reddington is down about 3%. Escorts Kubota is down 2.5%. From the frontliners, Titan is dragging. SRF is under pressure. TVS Motors down 1.5%. So do keep all these stocks on your radar. Also important commentary coming in from the Britannia conference call. Varun Berry talking about a 15-year high market share for the company, and the stock is up 9%. But the board of IDFC First Bank has approved a fundraising of 4,000 crores via the equity route. Remember, the current Tier 1 capital ratio is at 13.6% and the total capital adequacy ratio is 15.5%. To understand the rationale behind this fundraise and also the status of the merger with IDFC, V. Vaidyanathan, the MD and CEO of IDFC First Bank, is with us. Mr. Vaidyanathan, good morning and thanks for joining us on the show. This is Sonia here. I just wanted to ask you first about the fundraise itself, right? Why are you looking to raise funds when your capital adequacy looks like it's more than sufficient? I think you consumed a little over 1% of Tier 1 capital in the past 12 months.
Yes, indeed. Our capital adequacy, total capital adequacy is 15.4%. Now, every quarter we're posting over 550 crores of profit, which is also internal accrual of capital, which is pretty strong. But, we are a bank and we do capital planning exercise from time to time. And as per our capital planning exercise, we thought that during the next 1 year, we will like to raise some amount of capital. Maybe a real requirement, maybe a little less than that, but, in a rounded-off sense. So that's what we put out in public domain.
So what will your capital adequacy ratio be after this fundraise?
No, this fundraise is not that there's a fundraise happening tomorrow morning. This is, like I said, it's a 1-year enablement process. So it will depend upon when we raise it. But clearly, that amount of capital could give us a lot of headroom for growth in the future.
Mr. Vaidyanathan, good morning. Good to speak with you. But so this has got nothing to do with any potential sort of issues on the asset quality or anything to guard against that, have some guardrails there, or anything you want to tell us? Yeah.
Oh, absolutely nothing. We've demonstrated over the last 4 quarters that our asset quality is absolutely superb. Our gross NPA on the retail side alone is like 2%. Net NPA is only 0.7%. Our SMA, which is the portfolio, the pool that's moving into NPA, is only 1%, both SMA 1 and SMA 2. So that gives you a color about what really asset quality is really fantastic. This is really for growth. You can take a word for it. This is plain and simple for growth because we are growing the bank loan book at 25%, and therefore good to be really well capitalized in today's times.
You're clearing the air on that front as well, Mr. Vaidyanathan. The other point the street is waiting for is that impending merger with IDFC Bank with IDFC. IDFC has sold their AMC business, so they'll be sitting on 4,000 crores odd. So that's why the street is a little bit confused why you're going ahead and raising. Do you want to clarify on that front? What's the update with regard to the merger?
See, we are an independent bank. We have a strong incremental return on equity, like I told you earlier. And we need to plan for our growth in our own sense. So if the merger happens along the way, that of course brings in the capital and probably, we'll figure that out. But as of now, it's a pretty simple, straightforward. This bank needs this amount of capital for the next 1 year, keeping growth ambitions in mind, and that's what it's all about.
So what's the status as of now of the merger?
Pardon me?
What is the status as of now with respect to the merger?
No, about the merger, there's nothing new to share to the media because as it's already disclosed to the exchanges, both parties have said that we are interested in the merger. And I assume that will take its own normal course.
Okay. In terms of a timing, do you have any timeline on this fundraising plan? I mean, you said it's going to be over the next 1 year, but can you give us a timeline on when this could be completed?
No. See, when we say 1 year, it's 1 year. So it could be really any time over the next 1 year. And the requirement may be at least a tad short of this number. But let me just say that you have a full year. And meanwhile, we are pretty confident of the numbers that's coming up in the next few quarters in terms of profits. You've seen the trajectory of the last 4 quarters. The ROE has moved from 4% to 10% in the last 5 quarters. So really, you can see how that story is playing out. So really, those are the big things to look out for. In terms of timing, it will happen when it happens.
Mr. Vaidyanathan, good luck, and we'll speak again when you decide to exercise that option to raise money. Appreciate you joining in with some details on the idea, the thoughts behind having this with you, the ability to raise the money.
On this one last point on this front, because you specifically raised, and I need to clarify to people, is that the way we are looking at the bank is that what you should look forward to is to what's the results of the next few quarters. You should look forward to a bank growing. You should look forward to return on equity. You should look forward to asset quality, and you should look forward to the opportunities ahead. So really, that's the big thing to look forward for. Raising capital for banking system is normal. Every bank raises capital from time to time for growth.
Since you brought up ROE, so the expectation is ROE of 10% for 24. Is that the way to think about it?
Let me just say that.
Yeah.
No, we're running ahead of our guidance in terms of this year's guidance. We actually said the fourth quarter will reach double digits, but already reached the second quarter. So we are feeling very bullish about our bank even on the ROE front as well as overall.
All right, Mr. Vaidyanathan. Thank you very much. Good speaking with you here as always. So let's hop across to the next management who's ready to speak with us. Titan is the company I'm speaking about. Reported a good set of second quarter earnings aided by a one-off gain in its jewelry business. The sale of gold ingots worth 482 crores also aided the revenue this quarter. Ashok Sonthalia is Chief Financial Officer at Titan. He's joining us right now to take some questions. Let's start, Mr. Sonthalia. Good morning. With the jewelry business, which is the biggest for you. I was reading that new buyers in the jewelry space accounted for about 50% of the overall sales. So how should one read that? I mean, is that an unusually large number? And that would also mean that you are rapidly gaining market share. Can you address both those points?
Good morning, Prashant, and good morning to your viewers. Thank you for having me here. Yes, you are right. In quarter two, roughly close to 50% was new buyers, and it is not unusually high. It's a trajectory. A couple of quarters back, it was 42, 43. Quarter one, we reported about 46%, and now about 49% of customers are new buyers. This gives us confidence that definitely we are gaining market share. Some of the customers from the competition are coming and kind of experiencing us. So it's a good thing for us, and we are very happy about that.
Okay. Mr. Sonthalia, good morning and congratulations on a good set of numbers. But you have chosen to refrain from giving a guidance for Q3. Why is that? And do you think that you could continue to see this run rate? You've done about 18-19% growth in the festive season. Is that a one-off, or is that something that you can sustain through the year?
So we have started very well for the festive quarter. First month has been very good. And I must remind you that quarter three last year was also very strong with some spillover, pent up, all sorts of kinds of things because of the disruption of COVID. And in fact, this 17 to 19% amongst various categories, which we witnessed in the first 35 months of festive season, is very, very good and very strong. And we are very happy about that. Extrapolating that for the full quarter three may not be right, but that gives us confidence that quarter three should be turning out well for us.
Okay, hi, Mr. Sonthalia. This is Nigel on this side. A two-part question. One is your market share. You're gaining market share. You're currently at around 6% odd. When do you see it go to that double digits? That's around 10%. And the second factor is on the studded business. That was, I think, around 32% in the past quarter.
Right.
What is the steady state number that we're looking at? I think you had ambitions in the past to move that higher as well. So, clarification on both these 2 points.
So, on the studded part, this quarter was 32%. Growth was very good, particularly on high value studded. 37% last quarter to FY20, which is pre-pandemic quarter, was slightly aberration because all of a sudden gold prices have moved in that quarter substantially, and that is where studded percentage was high. Gold jewelry sales was slightly lower in that quarter. And quarter two is typically a studded quarter, where we do activation and a lot of promotion of diamond jewelry. So from that point of view, 32% is a good number. We want definitely to progress. But as I was talking earlier also, that we focus on all categories within gold, within jewelry, within diamond, and these generally becomes an outcome for us. But on a large scale basis, our endeavor is to kind of inch up this number slightly. But we are happy with the growth in overall absolute number of diamond category and the high value studded for us.
The market share?
Nigel, if you can repeat your first
Your market share,
question.
sir. Market share, you're gaining market share. It's at 6%. When does it go to 10%? You have an ambition, but give us a timeline.
So FY27 vision, which we have presented, that we want to be 2.5x in jewelry business. And considering the long-term jewelry industry growth trend, and we are hopeful that we will deliver that, we should be closer to 10% by that time.
By 27.
At least 9. Yeah.
Okay.
All right. Just a quick point. You've highlighted that you are, Mr. Sundalia, seeing some pressure in the sub 50,000 to 1 lakh price category. But the high value segment is doing very well, so that kind of more than offsets that. But is this a worry, the lower end of the price sort of range products doing, or maybe the value of purchase below a certain level doing poorly?
Okay, so, this is across category. Yeah. It is not only jewelry, we are seeing in watches category, eye care category. It is the entry price points which are growing slower than the premium and high price points. And that's right now to do with something, I would say, macro inflationary headwinds, where the bottom of the pyramid gets impacted most, and the food prices inflation, energy prices inflation hurts them most and further shrink their discretionary budgets. While mid-market, premium market seems to be slightly unaffected because of that and continue. So over a long term, we really don't see that this continues to play out that way. When we also look at, say, 3-year kind of horizon, we find both categories are growing pretty well. Some quarters up and downs happen. Maybe this bottom pyramid thing may continue for maybe another 2-3 quarters more before it comes back for us. But that's an important category for customer enrollment for us, because the new customers many times enter from that category.
Okay, and that's an important takeaway as well. We are noticing it in other sectors too, right? Premiumization has picked up quite a bit, especially in sectors like autos. I wanted to understand a little about store openings. You've guided for 35 to 40 Tanishq store openings this year. Will you stick to that? And also in the international space, right? You've said that you expect the international business to be 2,500 crores in the next 5 years. Can you give us a slightly more shorter term outlook?
So 35 to 40, we are sticking with that, Sonia. So 35, definitely we would like to achieve this year. But what doesn't get reported or understood, that a lot of existing stores are expanding. And, some significant retail square feet spaces are getting added to some of the premium stores. And that number, unfortunately, doesn't get captured, but it just gets captured in the retail space, which we also disclose. So we are very, very optimistic. Not only Tanishq 35-40, Mia is going to add about 50-60 stores. Carrot Lane is very aggressively adding another 50-60 stores. Zoya, for the first time, adding, after some gap, a couple of new stores. So store expansion is on track. Store expansion is keeping in mind our aspirational targets for FY27. And we are working on that. As far as the international is concerned, we are very happy. Already 5 stores are functioning in UAE. The first store in US has been getting delayed for some reason or the other, for some permission or the other. Hopefully by November end, that should also be up and functioning.
Okay.
We believe that whatever guidance we have given for 2,500 crore, we should be able to achieve earlier than that, because it is just our ability to establish and operationalize the store. After that, customers are just willing to embrace us with open arm, and we are finding very, very positive response in all these stores which are functioning.
Very quickly, sir, just doing a rough math and going by all that you said, should you end the year in that vicinity of around 37 to around 40,000 crores in revenues? And on the margin front, are you being conservative? Because you're doing margins, higher than what you have guided for in Q2. But for the year, you're still, guiding for a little bit lower margin, 150 basis points lower. Quick clarification on both these 2 points.
So, of course, Nigel, we are not giving guidance. I think we will allow our results to kind of give you guys confidence about our full year trajectory. As far as margin is concerned, there were certain one-offs benefit which came to us and margin has been higher. Our guidance for jewelry segment has been 12 to 13% EBIT margin. For eye care, about mid-teen margin, and watches about 13 to 14% EBIT margin. All these businesses, the priority is growth. Keep investing into brand, market share gain, customer acquisition, and deliver a stable margin profile. Competition is getting intensified across categories. We need to be mindful of that. While Tanishq remains a very, very premium and aspirational brand, but we need to be providing value to customer as well.
Got it.
So that's where a bit conservatism comes.
Okay. Sir, thanks a lot for joining in. All the best. You have delivered great returns to shareholders in the past. Hopefully, you'll continue to do that in future as well. Thanks for joining us on CNBC TV18. By the way, the market has come off 100 points from the day's high. So 18,255 was the high point of the day, of the morning, that is. And Nifty is now 100 points off. One set of disappointing results that came through yesterday post-market hours was Escorts Kubota. Very weak earnings. EBITDA was down 33%. Margins have contracted because of higher material costs. The company also saw a one-time loss of about 73 crores because of an impairment of an investment that they made in JV Tadano Escorts. Bharat Madan, who's the President Finance Group CFO of Escorts Kubota, joins us now. Mr. Madan, good morning. Thanks for joining in. At 8.1%, these are the lowest margins that Escorts has hit in a very long time. Can you tell us when do you expect normalcy to return? And will the second half of the year also continue to clock in single-digit margins?
Hi, good morning, Sonia. Yes, you're right. I think the margins have contracted, and we've been pointing this out, because the very heavy inflation, which is still unabsorbed, because the inability of the industry to pass it on to the market. Because we know if we go beyond a point in the price increases, that will start impacting the demand. So luckily, the demand has been good, so which is visible in the volumes for the industry as well as for our company. But the margins have been under pressure. And if you look at last 6-7 quarters since the time the inflation started, and the margins have been coming down. And typically, it's an impact of numerator denominator, because you'll be able to pass it on the impact, but still it impacts your margin as a percentages. So we expect, I think the decline was also gradual, and same with the recovery will also be gradual. It will not happen overnight. It will take few quarters really to go back to the normal margin level. And we expect at least 4 to 5 quarters to be a sort of time, which will take us to the normal margin levels now.
Madan, but have margins hit a bottom? Can you say that confidently?
Yes, we believe so. So we believe because the inflation pressures are not softened now. So in the last quarter, there was hardly any inflation. So actually, it's more like a neutral quarter for us. And from Q3 onwards, we expect the benefits to start coming in for the deflation and the commodity prices. So from here onwards, the things should improve. So we think this is our bottom now. So we only should look at the positive side going forward. Next
it may take 4 to 5 quarters for improvement, right? It's going to be very gradual.
Yeah, that's right. The decline also has been gradual, but the deflation doesn't set in overnight. Obviously, the recessionary condition which we're looking at globally are going to happen gradually, and that benefit will start flowing in to the commodities market now. And we hope, I think that recovery should be visible now in the margin from next quarter onwards.
Also said that heavy inflation is hitting the industry and it's hard to sort of pass on the cost to consumers. So is it a strategy on Escorts front that you're willing to perhaps sacrifice on margins, for higher volumes? Because you're not only lost margins, but you're losing market share as well.
Well, it's not really the story with market share. I think if you look at this quarter, the market share actually has gone up. So till June quarter, yes, the market share losses were there, post which we took corrective action in the market. And some of that related to, in terms of especially the low-end models, where the impact was coming very heavily because of this inflation. So this is a very price-sensitive market. So we had to take some certain corrections in those pockets. And that result is visible in this quarter. So the market share actually has gone up by about 70 basis points. So after almost 1 year of losing market share, this is the first quarter we're seeing the positive traction has come. And October, the market share had gone up beyond 11%. So I'm sure these actions are taking fruit, and we'll see the result coming in. But as you know, this is a very highly volume-sensitive industry, so the volumes are the key. So I think even if it means some sacrifice in the margin, especially for the price-sensitive market, it still makes sense.
Okay, all right. So, Mr. Madan, if you could give us a sense, where does this market share move to? As you said, some bit of recovery from the lows. You briefly mentioned 11%. What is the targeted market share? If you could give us a sense of that. And also your smaller part of your business, the construction equipment segment, out there it reported an EBITDA loss. It was a negative margin. Does that go back to profitability from here on?
Yeah, so I'll talk about the tractor business first. So as you know, the normal margin tractor would be somewhere around 14 to 15% level, which is what I said it will take few quarters for us to leave that level now. But in terms of market shares, we are already at 11% plus in the month of October. And normally, as course, typically since the more north and central focused market, which is the more seasonal months in the second half of the year. So normally we got a higher market share in the second half, which is seen becoming now visible from October onwards. So we hope by the year time we end the year, the market share overall will be better than the last year, definitely. And from here onwards, we only look at the recovery happening in the coming year too. And good thing is this time the stronger markets have done very well, especially the markets in north and central doing extremely well. And south has been weak, which has gone in favor of the company also in this period. On construction, yes, there have been some losses. The last year, if you look at the volume front also, so it was the second quarter where the volume, there's some pent-up demand was there, where the first quarter had seen some of the impact of the second wave of COVID, and also because of the emission norm which had come into effect from the first quarter. So that had impacted the demand in the last year first quarter, which got shifted slightly to second quarter. So that's why the base for second quarter had gone up. So but we don't see any negative or downside, on the construction equipment side. The infra story is still intact, and we are looking at some good dollars coming in, on that front. And normally second half post-monsoon is the time when construction activity picks up, and we expect the volume will pick up now in the second half of construction business too.
Okay, I guess Nigel's question was also more on profitability, but you said that on the tractor industry volumes, you had guided for a mid to high single digits growth for the industry by FY23. Given what you've seen in the first half, would you stick to that growth guidance?
Yeah, because earlier we were actually guiding for the mid-single digit sort of growth, low to mid-single digit, and now looking at the first 7 months now, the growth has been close to 7.5%. So we expect the volume growth will continue. So it will be somewhere in the high single digit now. It won't touch double digit, doesn't look like that. But again, this should be a new record peak industry level, which industry can touch in this year.
All right. Thank you very much, Mr. Madan. Appreciate you joining in with that perspective, and good luck on margins. It'll take, as you said, it fell slowly, it'll rise slowly, it'll recover slowly as well over the next 4 to 5 quarters. Well, the market's lost almost 70 points actually from the day's high. We're at 18,166. It's picked up a little bit from the low point as well. The one area which continues to do very well is the Nifty PSU Bank space. And I think you can just make a quick mention of that before we take the break. The PSU Bank index is up 5%, although it was up 6.5 earlier. So that has also come off, but it's a 5% gain on a sectoral index. So it tells you where bulk of the price, momentum, price action, etc. is. It's the PSU Bank space. We'll take a break here. We are back. Mitesh Thakkar joins in with some technical trading ideas. Important to get that with the market coming off. We also will have S.N. Goel, Chairman and Managing Director at IEX, the energy exchange, to discuss their second quarter earnings. Stay tuned for all of that. Okay, welcome back. As I said, we are off the highs and just 46 points on the day now. Mitesh Thakkar is with us. Mitesh, good to have you back. Is this the dip that you buy or wait it out a little bit longer? What would you do?
So I think, Prashant, between the Nifty and the Bank Nifty, I think I'm more inclined towards buying the Bank Nifty today, purely because of the fact that last few days, the Bank Nifty has been sideways between 41,000 to about 4850 on the downside to about 41,500, 600 on the upside, and we are trading above this 40,600 mark. So I think that's the index which I'll focus upon. The Nifty has been rallying for the last few days, still remains overbought. So between the two, I think the Bank Nifty has a higher chance of succeeding in the short term on the upside down on the long side trade. The Nifty maybe you would want to see slightly more of a dip, closer to about 18,100 levels to possibly venture into a long position. And on the stock side, I have one buy and one sell. Steel Authority of India is buy. It was a buy earlier as well, and I think suggesting to take positions over here. That's a buy with a stop below 85 for targets of 90. And SRF is something which is slightly negative though. On Friday and today, I think the low is 200 average at about 2440 level. So if it breaks 2435, 2430, go short, keep a stop at 2460 and look for targets of 2370 minutes.
Right. Thanks a lot, Mitesh, for that. Let's shift focus now to the commodity markets and get a quick handle on what's happening there. Manisha Gupta is joining in for that. Manisha, good morning.
Morning, Sonia. Thank you so much for that. Well, barring a couple of commodities, almost everything has seen a bit of a decline as we open for the Asia for this Monday morning. Natural gas is up 10% and iron ore price is up 4%. But apart from that, everything else is trading on a weaker side. And this is after China has reiterated that the strict COVID containment approach is something that they will continue to work on with. The Friday the gains all but have seen some decline come in. Apart from that, China COVID cases have continued to gain. They are the highest since the month of August. And then there is this safe haven buying that you have seen come in for the US dollar index and the dollar that's trading on the higher side. So the Asian currencies are trading weak and many of these commodities also have continued to decline. I'll start with the crude oil prices, and that has come off its 9-week highs that we saw on Friday. We did see $98 per barrel as well for the Brent prices, and it was a near 6% of gain in the previous week for the Brent prices. WTI closed nearly 3% on the higher side for the previous week, but we have seen both of these varieties open Monday morning slightly weaker. Metal prices, it's the same scenario. Copper is off its 2-month highs. We did see copper prices gain up by nearly 6% on Friday. It was 3.6 almost back in case of copper. Zinc, aluminum, both of these metals also gained up by nearly 4% on Friday. But today in the Asian markets, it's down between 1 to 3% for many of these base metal prices. Precious metals are also off their multi-week highs. We did see silver prices gain up by 5%. Gold was up 2% on Friday. Profit taking coming in for both of these commodities as well. The good point, though, is that from the lows of the previous week, we are still 3 to 5% higher on many of these metal prices. What the street will watch for is the U.S. midterm elections. You have the U.S. inflation data coming in this week as well. You have the trade and the investment numbers from China also coming in this week. And then, of course, the markets will watch out for the trade numbers from China as well. China also saying that the liberalization policies will continue going forward. So some more stimulus, some more easing could come in from China in this week as well. And that could be quite supportive.
All right, Manisha, thank you very much for that. Commodities in focus. Now, let's revisit what's happening with Britannia and, of course, the holding company, which is Bombay Burma. Rub-on effect there, Mangalam?
There is a rub-on effect there, but as far as Britannia is concerned, the street was bracing itself for a good day, but the stock price has given it a treat. It's a fresh record high, and the company is, crossed that 1 lakh crore mark in terms of market cap as well, and that's understandably so because they've reported the highest ever revenue growth. Gross margins have improved both quarter on quarter and year on year, and the market share is at a 15-year high. The numbers are above street expectations on all parameters, a volume growth of 4% as well. The only concern that the street had was an increase of 1,000 crores in their long-term debt, and the management in their conference call has, assuaged a lot of concerns that they had. The first one was they took debt to fund capex, and because the cost of debt was just around 5.8%, it made a prudent decision out there. Bombay dying was one of the concerns. They've exercised their right to appeal against the SEBI order, so that's the other concern that has been taken care of. The third one, they expect, while raw material prices have seen some firming in wheat as well as dairy, they expect it to at least remain stable, if not fall going forward. The overall new product contribution in their revenues is close to around 5%, and croissants could actually do 150 crore in terms of sales by the end of this year. And finally, on the management itself, they've said that the newly appointed ED CEO Rajneet Kohli, who was hired from Jubilant Foodworks, will take full charge of day-to-day operations of the company. So all these things will perhaps, assuage street's concerns, and as a result of which we are seeing the way the stock has moved. And as a result of that, we've also seen Bombay Burma move. They hold about 50.5% stake in the company, worth nearly 50,000 odd crores. And Bombay Burma's own market cap is close to just around that 6,500 crores mark.
Okay, all right, Mangalam, thanks a lot for that. Indeed, that's the big mover today. Well, let's focus on the next corporate, though. IEX, they posted a muted set of numbers in the second quarter. Revenue is seeing a 14% decline. Volumes as well did contract in the past quarter. Mr. Goel, the chairman and MD of the company, joins us now on the show. Hi, Mr. Goel. Good to speak to you. Thanks so much for joining in. Well, Mr. Goel, the market has been worried about the weakness we're seeing in the DAM volumes. And you have maintained that there's an arbitrage in the DSM and DAM market. So DAM volumes, they are being diverted to DSM. But this arbitrage is there since a long time. Isn't it evident that you're losing market share to HPX?
No, in fact, if you look at our day-ahead market and RTM market volume combined together, I think we are maintaining the volume growth also in this segment. And though this year particularly the volumes have been flat, otherwise we are maintaining that volume growth. And as far as market share is concerned, market share when there was acute shortage of power at that time, yes, the market share had gone down to 90%, but in the month of October, the market share is back to almost about 94%, 95% now.
Okay, all right. So according
I don't see any loss in the market share.
So according to you, sir, you're saying that you haven't lost market share, right?
No.
The fear is that HPX, you're losing some market share. Then my counter question to you is that HPX, well, suppose they start floating these conventional products. Currently, it's only DSM, right? Wouldn't that be a risk to you, or do you believe you can still hold on? Go ahead.
See, on exchange platform, the volume really happens in the day-ahead and RTM market. And these are the flagship products of the any exchange. And in these two products, we have almost about 100% market share. So I don't see any challenge in that. Other exchanges also have these products, but they don't have any significant volume in these products.
Okay.
RTM is real-time market for those who are uninitiated.
Real-time market is where you can purchase power with just 1 hour notice.
Correct.
And this market is very useful now with the high renewable happening in the country.
Yeah.
And there is a lot of variability. So distribution companies are able to manage their supplies more efficiently.
Got it. Got it. Mr. Goel, there are some new regulations coming on just to take off on Nigel's point from the 1st of January, right? Which you've said should lead to this arbitrage going away.
Yeah. I mean, there is some arbitrage in the day-ahead market and the day-ahead contingency market, which is available at the moment. But from 1st of January, the new regulations should get implemented. And once that happens, even that arbitrage will be over. So the volume will further shift to the day-ahead market. And in fact, CRC is implementing the couple of new regulations from 1st of December itself. One of them is the deviation settlement mechanism. These regulations now, as of now, the deviations are priced as per the average price of the day. As per the new regulations, the deviations will be priced as per each time block clearing price. So, and that I am sure should lead to better grid management and shifting volumes from the DSM market to the exchange market. REC regulations are also getting implemented. New REC regulations also will be more market friendly. So, and from 1st of January, when this GNA is implemented, I'm sure that should give further volume growth.
So how long do you think it could take for volumes to improve, Mr. Goel? Because you have the onset of the winter season as well. You also have better availability of coal. In that context, the expectation is perhaps that volumes could fall further. That's what you mentioned in your last operational update as well. Can you tell us how long would it take before volumes, improve?
In fact, in the month of October, the prices have reduced to almost about 3.8 rupees per unit. Last year, the prices were about 8 rupees per unit. There is a significant drop in the price. It is mainly because of better availability of coal in the market now. And I see in the month of November, in the first 7-8 days, the volume have already started picking up. And the demand, as we have seen in the last 7 months, is increasing every month, almost at a rate of 6 to 7%. So we see in the winter months also the demand increasing, and we should see volume growth in these next 5-6 months.
All right,
mainly because of the better availability of coal.
And you believe,
because, if you see the coal production in the second half, the coal production is much higher than what it is in the first half.
Yes.
So,
okay, all right. Very quickly, then, if you could tell us if volumes are going to recover for FY23, will volumes be flattish in comparison to FY22, or do you want to give us a number out there? And also, what's the update on embed? That was supposed to be the big driver, right? When do you expect implementation, Mr. Goel?
Yeah, numbers for FY23, it was a difficult year, mainly because of the very challenging conditions which were prevailing in the commodity market and energy market. But in spite of that, I'm sure we should close this year with the number which we achieved last year, because last year our volume growth was almost about 37%. So we should be able to achieve the same number. As far as MBD is concerned, the discussion paper is now with CRC. And CRC is yet to issue a discussion paper, and after that they will do public consultation. So it's very difficult to say when it will get implemented.
Mr. Goyal, if you can put a number on that volume, is it possible for you to put a number to that volume? Well, they're down about 10% in the first half. What would it look like in H2?
No, in the first half, the volumes were almost about only 3% down. And I'm sure by the end of the year, we should be able to make up that.
Electricity volumes on the exchange?
Yes.
Okay.
In the first half, it is 3% minus.
Okay.
And by end of the year, we should be able to achieve the number which we achieved last year.
Even it out back to F522 levels.
It is about 102 billion units.
All right, fair enough, Mr. Goyal. Appreciate you joining in, and thank you very much for running us through all of that. By the way, 12 or 13 points higher, and we're at 18,113. So this is at the low point of the day for the market, the Nifty, that is. We'll take another quick commercial break here. I mean, it's a sort of big corporate day with lots of companies joining us. Sanjeev Chadha of Bank of Baroda is our next guest in the program. Stellar numbers from Bank of Baroda. Stock reacting very positively. You'll hear from Mr. Chadha.
Welcome back to Bazaar Morning Call. Well, the stock of the moment undoubtedly is Bank of Baroda. It reported a very strong set of second quarter earnings. There's almost a 60% growth in the net profits, while the asset quality has also improved. The bank's return on equity is at 19.6%, which is, I think, the highest that we've seen in the last 7 to 8 years. Sanjeev Chadha, the MD and CEO of Bank of Baroda, joins us now to discuss more of their Q2 performance. Mr. Chadha, good morning and thanks a lot for joining us. You know, banks seem to be in a sweet spot at the moment with loan growth improving, credit growth back on track and asset quality situation stabilizing as well. Can you tell us what could the second half of the year look like, and what's an average loan growth that you see for Bank of Baroda?
So thank you very much, Sonia. So you're right. I think the improvement has been in train for a few quarters. I think it has been led mostly by the improvement in asset quality and credit costs coming down. We have discussed earlier also that this improvement was there even 1.5, 2 years back, in as much as the corporate credit cycle improved. Only it was obscured by COVID for some time. But now that COVID is behind us, not only is the corporate credit cycle translating into lower credit costs, but also sectors like MSME and retail loans are also improving. The second part, of course, is that what we see is a much stronger growth momentum. Even if we allow for the fact that there is some base effect because of the second wave last year, even then, discounting that, I think growth is much stronger as compared to what it was a couple of years back. It is also becoming more and more broad-based. In the context of BOB, I think what is remarkable is that the digitalization agenda is something that has enabled us to decouple growth from growing the cost base. So today, BOB is number one in terms of e-stamping, e-signs. 84% of personal loans are done through digital, nearly half are MSME loans. So I think all that means that even as we go ahead, while growth happens, we are not increasing costs in tandem. Now, in terms of a question about the second half of the year, to my mind, these trends should sustain, which means that the credit costs should continue to be low. And in fact, in our case, we believe there is scope for more improvement as we go ahead. But apart from that, if we were to discount the base effect, the growth will also continue to be fairly strong. Certain supply constraints, for instance, semiconductors in the case of cars, for instance, have gone away. So I think overall, I believe that the prognosis is positive, and the valuation gap that we had seen in terms of public sector banks vis-a-vis private sector, I think that ought to narrow over the next few months and quarters.
Okay, well, just to talk a little more about the loan growth, right? I want to understand, where is it coming from? Are you seeing some fresh projects being put on board? Is there fresh capex from the corporate side? What about retail? Or is it just the existing projects that are sort of pumping in money?
So as a stance, the bank had thought that we would want to rebalance our balance sheet, in as much as that you would want a larger share of retail as compared to corporate. Corporate for us was nearly half the balance sheet. It is still maybe about 45, 47%. So there has been a trend for us to push retail loans faster. This quarter has been exceptional, in as much as that the retail loan portfolio has grown as much as 28%. But within that, it is very, very broad-based. The second part is that home loans was a little bit of a weak point for us. Car loans were growing for many years at 20% plus. But now home loan growth is also coming through at nearly 20%. So I think growth is broad-based. For us, it is much faster in retail as compared to corporate. Partly it is we continue to maintain very, very tight discipline in terms of pricing, which is why our margins have improved along with growth being delivered. I would believe going ahead, as we again look at the working capital utilization pickup, there is scope for corporate loan growth also to be faster than as what has been. So therefore, to my mind, in our case, we would expect corporate loan growth to pick up, contribute a little more, and therefore to the extent that there is a base effect that gets to some extent evened out by faster corporate loan growth.
Mr. Chadha, this growth has shown up in the international business as well. Could you briefly provide some color? Where is that coming from exactly?
So I think that has been the case for us for maybe about 3 or 4 quarters. The reason is that because of the abundant liquidity in India, we found that margins in corporate in India were lower as compared to what we were able to find abroad. And having a significant footprint abroad, we had the option of allocating capital wherever the return on capital was better. So this loan growth is largely in the corporate sector. These are very well diversified. It's a very well diversified loan book because we are a relatively small player abroad, which means that you have the opportunity of picking up a lot of relatively medium-sized exposures rather than the kind of concentration risk that we run into our domestic market because we are one of the larger players there. So it has been, just to give you an example, along with growth, we have actually been able to get better earnings also. So about one year back, our net interest margins abroad used to be about 1.3%. Today, they are north of 2%. And if we also juxtapose that with the fact that in terms of cost to income, it is 50% in India and it is less than 20% abroad. So after adjusting for operating costs, the international loan book is delivering a better return. So it is actually earnings accretive rather than dilutive for us.
Okay, just one final question on credit costs. Do you see it improve further? Because you just briefly mentioned that credit costs are on the lower side. But would you want to change your guidance on credit costs compared to what you said earlier?
So I think credit costs have been trending downwards. And to my mind, there is scope for it to come down further as the residual impact of COVID dissipates. We had guided earlier that credit costs should, for the bank, be between 1.25 and 1.5%. Although they are less than 1% this quarter, but there always are uncertainties. So for the moment, we have improved our guidance to between 1 to 1.25%.
To 1.25%, which is better than your earlier guidance based on what you've done in Q2. Mr. Chadha, we have more questions, but we're out of time, so we'll have to sort of take that up later. Appreciate you joining us and running us through details of what has been an excellent quarter for Bank of Baroda at this point. Well, 22 points, so the market's absolutely flat now. But don't let the index fool you. But I think what's happening is that the broader market is doing just fine. And I think you only have to look at the NSE advanced decline ratio, 2:1, over 2:1 on the NSE advanced decline, with the Sensex now in the red. So that's quite remarkable. That's what I'm talking about. More on broader markets, mid-caps, etc. coming up on the other side. From Sonia, me, the entire Bazaar team, thank you for watching. And more comes up on the other side of this break.